Technical analysis relies heavily on visual representations of price data. Candlestick charts are a primary tool for visualizing price movements over time. Line charts offer a simplified view, connecting closing prices to illustrate trends. Bar charts provide a detailed breakdown of price action within specific periods. These three chart types, candlestick, line, and bar, are fundamental to technical analysis. A line chart is a visual representation of data points connected by line segments. It is commonly used to display the closing prices of an asset over a specific period. The simplicity of a line chart makes it easy to interpret. Line charts are optimal for identifying general trends in the market. The direction of the line indicates whether prices are generally increasing or decreasing. This makes line charts a fundamental tool for basic market analysis. Line charts are optimal for rapidly assessing overall market direction. They provide a clear visual representation of trends over time. This makes them particularly beneficial for beginners in market analysis. The simplicity aids in understanding general market movements. A bar chart is used to display key price points over a specific period. 4 key prices are represented in each period: the open, high, low, and close. The opening price is indicated by a tick on the left side of the bar. The closing price is indicated by a tick on the right side of the bar. The high and low prices define the upper and lower limits of the bar's vertical line. This visualization provides a clear representation of price movement within the specified time frame. Bar charts offer a detailed view of data, making them useful for active traders. Active traders require granular price information for decision-making. Bar charts provide this detailed price information more effectively than line charts. The level of detail in bar charts supports in-depth analysis. This allows traders to identify specific price movements and trends. Ultimately, bar charts aid in making informed trading decisions. The candlestick chart is a popular tool for visualizing price movements. It uses candle bodies to represent the open and close prices. Wicks, also known as shadows, indicate the high and low prices for the period. This chart type provides a clear representation of price action. Candlestick charts are used to visualize price movements over time. Each candlestick represents the price action for a specific period. The color of the candle indicates the direction of price movement. A green candle signifies that the closing price was higher than the opening price. This indicates a price increase during the period. A red candle signifies that the closing price was lower than the opening price. Line, bar, and candlestick charts are different visual representations. These charts display the same underlying price data. Each chart type presents the data in a unique way. Line charts connect closing prices with a continuous line. Bar charts show open, high, low, and close prices as vertical bars. Candlestick charts also display open, high, low, and close prices using candlestick shapes. Line charts are known for their simplicity in displaying trends over time. Bar charts excel at providing detailed comparisons between different categories or data points. Candlestick charts are visually rich tools commonly used in financial markets. Candlestick charts are particularly useful for understanding market psychology and price movements. Each chart type serves a unique purpose in data visualization based on the information it conveys.